What's up, y'all? In this video, I'll be breaking down what are fair value gaps, why are they important, and how you can use them. So let's get to it. So as we can see here, we have a bearish fair value gap and a bullish fair value gap. So a fair value gap is a 3-candle pattern where you have your first candle's low and your third candle's high in a bearish example, where price left a gap because the wicks never overlapped each other. In a bullish example, you have your candle 1's high, your candle 3 is low, where the wicks haven't overlapped. It's basically like price delivered in one direction and it never came back to filling those orders after price came down. Price never wants to just deliver in one direction. It has to be fair, which is why it's called a fair value gap. Price has to pull back to fair value to give sellers an opportunity to sell the market after they then took external liquidity, and then now they had to deliver the internal liquidity to then go back to external liquidity. Same thing in a bullish example. There were orders left over, so they gave the buyers a chance to get back into the market at a fair value so they can trade it back to external range liquidity. So I'll be going over some chart examples of bullish and bearish fair value gaps. So as we can see in this example, price had took out these highs here, traded back inside the range, and it broke structure here at this swing low, taking out external liquidity of this range. So now that we have a swing low, we anticipate that price will pull back inside this current range from this high to low and go inside this range at a premium into a fair value gap. So as we can see, this is the only fair value gap that we have in a premium. So let's just see how price play out once it gets to this fair value gap. So as we can see here, price is reacting to the fair value gap. Now we want to see price come and take external range liquidity after it just took internal range liquidity. So as you can see, price just took this low at external range liquidity, and now price created a new swing low. So let's see if price can go back to a premium again inside internal range liquidity at a fair value gap. Let's see how price react to it. So we have a fair value gap right here. And let's see if price can get back to this fair value gap and then trade back to external range liquidity. So as you can see, price went into that gap and then price took external range liquidity. So in this bullish example, we can see that price had broke structure to the upside right here. And then created a swing high. So now that we had this swing high, we expect price to come back inside this range from the low to high at a fair value gap inside a discount, and then trade back higher to external range liquidity. So as you can see, price tapped into the fair value gap and then went back to external range liquidity. So as we can see in this bearish example, price created a new swing low. We draw our premium discount from high to low. We can see that price has a fair value gap and a premium that we can use to trade from internal to external range liquidity. So let's see how this play out. So as you can see here, price created a swing high. So now we can go to our 15-minute time frame to see if price broke structure to the downside and gave us a change state of delivery. So as you can see here, price gave us a change state in delivery. So I'm gonna look to see if price can break this low here as well to give us another change state in delivery, and I'll look to enter and put my stop loss at the swing high. So as we got this change state delivery, I'll be putting my entry in right here, and I want to keep my stop loss above those highs, and I just want to target this external range liquidity at a 1 and 2. So let's see how this play out. So after the second change of stand delivery, we can see price trades his way back inside the range, and then now we can see price starting to deliver towards that external range liquidity. And as we can see, price came and took out this external range liquidity at these lows. So in this next bullish example, we're going to see how we can use our premium discount to an advantage with fair value gaps to get a good entry criteria to trade higher to external range liquidity. So as you can see here, we have a low, price create a high, and price is sitting in the premium of this range from low to high. So let's see if price can make its way down to this fair value gap and a discount and see if we can get an entry from there. So So you can see, price came down inside this range, and now we have a swing low. In order for price to be bullish, I need to see price break structure on a 1 hour time frame to show me that we want to continue higher. So as you can see here, on the 1 hour time frame, price gave us a change of standard delivery, and then price came right back down, gave us an optimal trade entry here, which would be price coming to a 62%, and then trading away. So what I would do here is I would wait for price to give me another change of state delivery right here, close above here, and then look for an entry. So as you can see, price gave us a change of state in delivery. So now I want to see if price can come back inside the range, inside the fair value gap. So this fair value gap here, I would look to enter here and put my stop loss below the swing low. And then I want to target a 1 or 2. So let's see how this plays out. So as we can see, price breaks higher and hit our 1 and 2. So if this video helped you guys understand fair value gaps, how they're important, and how you can use them, hit that like button, subscribe button, and comment below. It's your boy AP Reese. Appreciate y'all. I'm out.